In today's video, I am going to be breaking down ZWB as well as CIC. These are two Canadian bank ETFs that run a covered call strategy. What a covered call strategy is basically allows you to make more money from the shares that you hold by basically selling a call option against the shares that you have. This will allow you to basically make the premium off of those covered calls, so that now you are still making the money from the dividends from the banks. You're still making money from the banks, but you are now making the premium from those calls. However, the downside is if the stock price that you set is at or above from where you set it for the covered call, you now need to basically sell those 100 shares to whoever has that call option, of course, if they exercise it. So that's kind of the downfall to the covered calls, but at the same time, if you can get them far enough out of the actual money, then you'll make more money. But this is a long process to explain, so I'll cover a covered call strategy in another video. Let's get down to these two ETFs. So as I said, ZWB is the ticker for this first one. The annualized distribution for this ETF is 5.79% as of the time of making this video. And the MER is 0.72%. So that is how much money it will cost to hold on to ZWB. Now, for example, if you were to invest $100 into this ETF, every single year they would take 72 cents from you to, of course, pay themselves for investing your money. The nice thing is the distribution is monthly, and when it comes to the risk rating, their rating is medium. I would also say it's about medium as well. And this is an ETF that is on the TSX, and its average market volume per day is around 418,000 shares every single day, which is just absolutely insane. There's a lot of shares being traded. It's very liquid. You can get in and out very easily. Now, this ETF has been around for a very long time, and just like the Canadian banks, it traded within a range. Most Canadian banks, other than like National Bank, and they were just basically all trading sideways anyways. Recently, they have been exploding to the upside, and we see that here. So from this standpoint, this one does seem to stay in line with the Canadian banks, which is nice to see. You never want to see a covered call ETF declining versus the actual sector that they're covering going up. You never want to see that. You want to see exactly roughly where the actual sector is traveling, and that's what we see here, which is nice. As I was mentioning, they do pay every single month, and we can see that just recently they upped their dividend, which is nice to see. It's gone from 8.5 cents to 10 cents per share. And of course, their holdings are the big six. We have CIBC, Bank of Montreal, Royal Bank of Canada, National Bank of Canada, TD. We also have the BMO equal weight banks. ZEB is the ticker for that one, being held at 27%. And of course, we have the options that are being sold against those. Now, the one that we are comparing this up against is the CI, Canadian Banks Income Class ETF. CIC is the ticker. From there, the expense ratio is higher. It's 0.8%. So again, for every $100, this one would take 80 cents from you. And what you're hoping for is for that MER to be basically removed, or at least not even a factor, because of the stock price going up more than that every single year. That is what you're essentially hoping for. This one does have less volume at 22,000 shares traded per day, but it's still a pretty good volume, because I doubt you're going to be trading 5 to 10,000 of these shares within a single day. So that's pretty good. The yield is a heck of a lot better at 7.9% versus the 5.6 or 5% the ZEB is at. ZWB, my fault. So ZWB is at that 5.79%, while we have CIC at 7.9%. So 2% better. That is a heck of a lot better in my books, personally speaking. As far as the chart goes, again, basically mirroring the stock market and when it comes to the Canadian banks, trading within a range. And then, of course, the massive upside recently, just very close to hitting, if not just past, the all-time high. Now, the thing about this covered call is it's not the same as ZWB. ZWB is a bit different because ZWB pays basically the same every single month, while we have CIC who pays quarterly, and it seems to be different recently every quarter. So we have from 2018s and 19s, it's giving you 17.5 cents every quarter. And then it went up in June of last year to 33 cents. It's then dropped back down to 24 cents, and then down to 18 cents, and then now down below where we were at in 2019 and 2018 of 17.2 cents versus 17.5 cents. Is that scary? Not necessarily, but it is something to really keep an eye on. Something else is, of course, what it holds. CIBC number 1, National Bank number 2, Royal Bank, TD, Bank of Nova Scotia, and, of course, BMO. These are all my favorite banks in the entire world, so I personally really like this ETF myself. Now, when you start comparing these two, if you're looking for a set income every single month, ZWB is going to be the one that you're looking at. However, if you're okay with the fluctuations in the dividend, if you're looking for a larger dividend and don't need it every single month, CIC is the one to go with. Both of these ETFs are good, and they both have their own niches. If you're retired, you might want to go with ZWB because it is it's pretty well standard. You know what you're going to get every single month, almost like a job. Meanwhile, with CIC, it's every quarter, and it could be more, could be less every quarter, and it's hard to foresee what's going to happen into the future. However, it is a larger dividend, so if you're younger like me, you could always put more money into that one versus ZWB. Overall, both great ETFs. That's the differences. I hope that this video has helped you kind of decide to choose. Remember, do your own research, know what you're buying, never trust a random YouTuber. I'll see you guys again in my next video.